Do you know the day of our annual members meeting, 19th of May 2022, is International Accounting Day, which is all about promoting the accountancy profession. However, despite all the training we get as accountants, it doesn't make it any easier to explain how we fared during the year covered by our annual report, given the impact of COVID and the global uncertainty we're faced with. I'm joined here by Lindsay, our Head of Finance and Data Analytics, to help explain what happened during 2021.
Hello. By the end of this presentation, Doug and I hope that you'll have an understanding of the things that have impacted our 21-22 financial year and of how we're addressing the future challenges that the society is facing.
And if what we say triggers any questions, use Slido to register your question and I'll do my best to answer it at the end. As we'll explain, 21-22 was a challenging year, but we expect 22-23 to be even more challenging given the economic headwinds. It's been a much tougher 12 months than we anticipated due to factors outside of our control. However, the resolve shown by our colleagues in dealing with the challenges we've faced has been staggering. They deserve all the credit for our positive impact in the region. We're all incredibly grateful for your support during these challenging times. As you can see, although we saw a small 1 million reduction in our turnover, we saw trading profits fall by nearly 6 million to 1.5 million. This is lower than we expected, which is disappointing and resulted in part from supply chain challenges in the second half of the year within our food business. So how did this happen? Let me try and explain. As you can see, sales fell by £1 million compared with the prior year. This was to be expected as shopping habits returned to normal following the national lockdowns. But what is really pleasing is that sales are over 13 million or 4% higher than 2019-20. But to really understand the story of our financial year, we have to dig deeper. As we said last year, it's only when you look at the detail that you can see that there's an awful lot going on here. So I'm going to look at each of our individual businesses, and this graph will show the difference between this year and last from a turnover perspective. Firstly, our food business. We saw its sales drop 11 million. Clearly that's a big fall. However, they were 5.9% higher than before the pandemic. We continue to adapt to changing shopping behaviour, and I'll show you just how dramatic those changes in shopping behaviour have been. This graph shows you how many food transactions we processed each week of the financial year over the last 3 years. The raspberry line is last year, the green line is this year, 21-22, and the dark blue line is pre-pandemic, i.e. 19-20. So what does this show? You can see when the first lockdown happened in March 2020. You can also see that the 32 million baskets this year is higher than the 30 million last year, but they haven't returned to the level of 19-20. We have undertaken more transactions than last year, but sales have fallen by 11 million. That can mean only one thing. Our average basket size has reduced. And that's what this graph shows. Average transaction value, or the spend per basket, is lower than last year, but pleasingly higher than pre-pandemic. But adding this all together means that food sales were down compared with last year, but 5.9% higher than in 19-20. As I said right at the beginning, despite all the training we get as accountants, it doesn't make it any easier to explain some of this. But we're not just a food business. Food is only one part of our diverse family of trading businesses. Overall, society sales fell by 1 million. Food sales fell by 11 million, so what grew to cover the decline in food sales? Our forecourts, petrol filling stations, saw sales grow by 9.6 million, a combination of increasing pump prices and a 34% increase in the volume of litres sold. We sold an extra 5.5 million litres compared to last year when government lockdowns depressed volumes. The dramatic swings in food and fuel sales overshadow the changes in the rest of our trading businesses, but they all have their own stories. Income from our residential portfolio grew by over 10% thanks in part to the completion of our Longwire Street development in Colchester. We conducted an additional 42 funerals, which saw sales in the funeral business grow by 0.2 million. Travel sales, although markedly higher than 2021, remain significantly down on the levels generated before the pandemic. But pleasingly, we're seeing travel sales recover this year. Co-op Secure Response generated sales in excess of 2 million. Sales in HL Perfect, our stonemasonry business, increased by 18.2%. Although sales in our events business grew, ongoing restrictions meant that they have not yet returned to pre-pandemic levels. Hopefully you now understand why sales were £1 million down on the previous year. So if sales only fell by £1 million, why have we seen such a fall in trading profits? Factors beyond our control have had an impact. The contribution to trading profit from our food business fell substantially, as I can show you. This graph starts with last year's underlying trading profit of 7.2 million, and I'll show you how we ended up at 1.5 million. The decline in food store sales was down to a combination of shopping habits stabilising following the height of the pandemic and supply chain disruption in the second half of our financial year. These supply chain issues meant that the availability of products in our stores was nowhere near the level we expect and the level you deserve. Not having the stock on the shelves makes it difficult to sell. The increase in funeral sales, together with controlling of costs, saw our funeral business increase its profits. The losses in our travel business were greatly reduced as we restructured the business to adapt to a lower level of business. The increase in central costs includes a transition cost for a new pension governance model, investment property development costs, and an increase in the cost of insurance. We also continue to incur costs relating to COVID, with rent relief for tenants, cleaning costs, and self-isolation pay for colleagues. I'm now going to hand over to Lindsay, who's going to give you an update on what that means for our profit before tax.
As Doug has just explained, our trading profits have fallen by £5.7 million compared to last year. But when you look at our annual report, the profit and loss account shows a somewhat different picture, which I'll do my best to explain in a minute. I'm then going to have a look at our balance sheet and show you that our members' funds have improved during the financial year too. In direct contrast to last financial year, our trading profits have fallen, but our annual report shows that profit before distribution and tax is considerably higher than in the last few years. I know that sounds confusing, but trading profit is only part of the picture. There are other types of profits and losses that impact the society that have little to do with how our shops or branches perform. Many of these are related to wider economic conditions and are outside of our direct control. You may remember that last year, due to COVID-related market conditions, our investment property portfolio fell in value, which had a negative impact on our profit before distributions and tax. We also suffered some trading property impairments, which meant our accounting profits fell to £1 million. Doug told you then that he wasn't worried because property movements are often temporary, and he was right. This year, our property portfolio valuation has increased by £6.7 million, which is why accounting profits are so much higher this year than last. The increase in property values has also had a positive impact on our balance sheet, which brings me on to the next slide, our members' funds. We've always had a strong balance sheet. We own over £300 million worth of fixed assets, and for an organisation of our size, have very little debt. In recent years, we've invested heavily in the future of your society, and this year was no exception, with just under £10 million of capital expenditure incurred. This includes 2 new food stores, one in East Harling near Thetford and Chesterwell in Colchester. I'm happy to say that these new stores are outperforming our original sales projections, and I'm pleased to welcome our new store colleagues to the society. Let's take a closer look at our members' funds position. This year, the Society's members' funds have increased by over £35 million to just under £235 million. As you can see from this graphic, members' funds have been volatile over recent years, and there's one main reason for this: our defined benefit pension scheme. Every year, in accordance with accounting regulations, we ask our external actuaries to value the assets and liabilities of the scheme and calculate the overall deficit. The valuation looks at prevailing economic conditions and makes predictions about the future. As you can imagine, making accurate assumptions here has over recent years become more difficult. You might remember that in the 2021 financial year, our pension deficit increased by 9.2 million, which, along with the fall in property values that I mentioned earlier, had a negative impact on our balance sheet. We saw members' funds fall from 214 million to 199 million. This year, we've seen a dramatic reversal. The pension deficit reduced by over £36 million and now stands at 11.4 million. This is good news for our pensioners as the scheme moves closer to being fully funded. It's also good news for the Society's balance sheet, which has strengthened as a result.
So to summarise our results, we've had another challenging year with the continuing effects of COVID-19 and Brexit. A lower level of trading profit was always anticipated. However, results were worse than expected due to supply chain disruptions beyond our control, which led to lower food retail sales in the second half of the year. The reduction in trading profits is disappointing, but as Lindsay has explained, we've seen a significant increase in our profit before tax.
Although there's a lot of economic uncertainty right now, the Society is well placed to tackle the challenges we face. We have a robust balance sheet, strong cash generation, and we continue to invest in future growth.
Thanks for your help in explaining our result, Lindsay. Time to go off and celebrate International Accounting Day.
Thank you.
Today may be International Accounting Day, but people come before money. None of the results we've achieved would have been possible without the dedication, hard work and commitment of our colleagues. They continue to be tested in ways we could never have imagined. As an organisation, we continue to provide essential services. Our colleagues have stepped up to meet the challenges we face, and we'll continue to do everything needed to support them. Like many others, we've been learning to do things differently. It's been a tough 12 months and we've tough times ahead. What keeps me going is the unshakable dedication and commitment of all our colleagues. They have been tremendous. But what does the future hold? I've said a few times that despite the challenges of the last few years, that we expect 2022-23 to be even more challenging given the economic headwinds. Global unrest is contributing to rising costs, especially commodity prices and energy costs. Inflation is rising and interest rates at this moment in time are at their highest level since March 2020. These factors are all contributing to an increase in the cost of doing business. In addition to these rising costs, we have additional regulation to contend with. We have the cost of implementing the change to food stores for high-fat, salt and sugar legislation, and the regulation of prepaid funeral plans also comes into force during 2022. We are well placed to manage the uncertain times ahead. Although we will need to make structural changes over the next few years to mitigate the rising costs of doing business, we do have a strong balance sheet. Our finances are sound and we'll continue to invest wisely to support you, our members and our communities. We are all incredibly grateful for your support during these challenging times. Thank you.